Welcome to our presentation on the harmful effects of student loan debt. Throughout our lives, we have been conditioned to believe that in order to achieve success, that we must go to school, get a good education in order to get a safe and secure job, and then if we just work really hard at that job, we can make a lot of money and buy anything we want. But is this really how things operate in the real world? In the real world, we must face the undeniable facts, and they are quite disturbing. Did you know the average college student graduates with about $21,000 in debt these days? Graduate and professional students borrow even more, with additional debt for a graduate degree ranging from $27,000 to $114,000. And jobs are getting more and more scarce too, now due to the migration of domestic jobs to overseas countries for cheaper labor and material costs, and also due to the current economic slowdown. Did you know the U.S. unemployment rate is almost at 10%? And nearly 8.5 million jobs have been lost so far, and there are now 14.8 million unemployed Americans who have been jobless for an average of 30 weeks, an all-time high. So what can you expect your life to be like after graduation? It can range from searching for a job, to figuring out your living arrangements, to plotting your finances. But more than likely, you will face the real possibility of unemployment, a lower paying job not even related to your field of expertise, and you will most likely face financial difficulty since you are already burdened by student loan debt. The number of students turning to loans to help them foot hefty tuition bills is rising every day. The National Center for Educational Statistics report that more than two-thirds of all four-year undergraduate students take out loans in order to fund their education. So right from your initial interest in the college, you are in debt. So what is debt? Debt is that four-letter word that keeps you from enjoying life to its fullest. Debt is the inability to pay our bills in full at the end of each month. We have debt when we take out those loans, when we purchase a new car, a new home, new furniture, and or when we use credit cards. And yes, we plan to make monthly payments, and sometimes we do. But in time, those monthly payments require all of our paycheck. So we work overtime to have some extra spending money and pay a little extra on a bill or two. We soon realize that our debt begins to hold us back, much like a heavy ball and chain. There are four reasons students get into debt. First, there is tuition. Tuition is what you must pay to enroll as a student and take classes at a college or university. Tuition is the main source of debt for most college students. Next, there is school choice. Many college students do not accurately factor in financial considerations into their decision-making process when deciding on a college or university. This leads many students to opt for more prestigious private schools that can cost many times more than a public university that might give equal educational quality. Did you know that it is common for tuition costs to exceed $30,000 at a private school? Bet you didn't know that. There is the lack of income. If you were able to work at a well-paying job during the school year in summer, the amount of debt you would have to take on could be reduced significantly. Unfortunately, the very nature of going to college, studying in order to learn vital skills to use later in life, conflicts with working. Wouldn't you agree that more time you spend working, the less time you have to study and excel in your classes? Because most jobs college students can get do not pay very well, it is a more valuable use of time to study rather than to work, taking on more debt with the intent of paying back with the skills that they learn. Finally, there is the lack of financial education. Even though you attend school to become more educated, most students are often not very well versed in financial issues. This can get you in trouble with easy access debts such as credit cards. Many students assume they will be able to pay back their debts easily once they graduate and get a high-paying job without considering the job market or how much money people in their field actually make. Here are two types of student debt. One of the most common debts is student loan debt. Paying for college or graduate school can be extremely expensive, especially if you have remnants of other debt to deal with. For example, many graduate students are dealing with undergraduate debt from college loans. Although it is sometimes possible to request a longer grace period for paying back college loans while still a student, credit card debt is also a very common cause of student loan debt. For some students, A credit card might seem like a green light to spend money, which can begin a spiral of ever-increasing debt. Students often use high interest rate debt such as credit cards to finance necessities such as food and books. The cost of higher education has grown rapidly, forcing students to take on more and more debt. Now, contrary to what you might have been taught or think, there are consequences to debt. Financiers are the number one cause for divorce in America today. Take time to stop and think. How many times have you fought over bills or not having money to purchase something one of you has wanted? Debt causes undue stress, which can quickly escalate into many physical as well as mental health problems. And what about your dreams? Do you have big dreams? Unfortunately, debt can destroy those dreams. Debt has a way of taking away our dreams. The more debt we incur, the less free money we have to follow our dreams. On average, 66%, that's two-thirds of college students graduate with some sort of student loan debt. While student loans help you achieve higher education, student loan debt can keep you from achieving other important milestones in life. Make a mental note of this fact. A 2002 Nellie Mae study found that because of student loan debt, 14% of graduates delayed getting married, 21% decided to wait longer to have children, and 38% forwent buying a home. And if you ever applied for a credit card or loan to buy a house or a car or a line of credit to make some other large purchase, then you probably had your credit report reviewed by the lender. If your report says you don't pay your bills on time or that you have a lot of debt, you may not get that loan. Or you may get it, but you have to pay a higher interest rate. Your credit scores help in classifying borrowers as either creditworthy or otherwise. It's designed to help lenders determine how likely you are to pay back your loan. If you have excellent credit, then you will be likely eligible to receive the lender's most favorable rates. In fact, you're in a good position to shop around and demand the best possible conditions. With good credit, you may no longer be approved for the lender's best rate, but you should have little difficulty finding a good loan. With a below average credit score, your options will be reduced and you'll pay a premium on your loan, perhaps as much as 2% more than borrowers with excellent credit. You may need to provide more documentation than those with higher scores, including a formal appraisal of your home's value. A credit score under 620 puts you in the category of a subprime borrower. You see, borrowing more than you can afford or not managing your debts properly can quickly lead to debt management issues that will only lead to more debt and make it that much harder to pay off. But just by eliminating the debt, someone can potentially raise their credit score from the low 600s to the low 800s. Though the cost might be occurring now, the repayment of debt will stay with you for years. Many students taking out federal and private loans or using student credit cards to pay for schooling don't consider the long-term effects of using this credit. But did you know that these debts become part of your credit report, which affects your entire financial well-being? Did you know they could affect the interest rates on your car or on your home, even your insurance rates? As a general rule, a higher score will entitle you better loan terms and a lower interest rate. Credit scores and reports are actually used for many other reasons. Your credit score can affect your ability to get a good rate on common necessities such as cell phones and even rental agreements. It can even affect your employment. About 35% of the companies surveyed by the Society for Human Resource Management pulled the credit reports of current or potential employees last year. So, knowing what we know about the harmful effects of debt, I am guessing it is safe to say that you want to know, how do you get out of debt? How can you eliminate your student loan or credit card fast? Well, you can earn more money, you can consolidate your loans and make larger payments, or you can put yourself on a strict budget. This is what financial experts say and what I consider the old way of doing business. You know why? Because life happens. Yes, it's easy to say you can get another job, but look at the job market today. Unemployment is at its highest. Sure, you might get a bank to consolidate your loans, but even if you get a lower payment on your loans, don't be fooled. The bank is still making a lot of money off your interest rates. And yes, you can budget, but with life uncertainties, you never know when your car, for example, will need a new transmission. Was that in your budget? I think Albert Einstein said it best. We cannot solve problems using the same kind of thinking we used when we created them. Folks, I want to extend an invitation to each and every one of you listening and viewing this presentation to go to www.erasemycollegedebt.com if you're tired of being in debt.